Hello everyone. Our subject is auditing and assurance as per NAP 2020 from MCOM part 2 semester 4. Our question is explain safeguards to auditor independence in India. To counteract these threats, Indian regulations enforce strict safeguards designed to uphold auditor independence. These safeguards are classified into regulatory, ethical, and procedural measures, which means to deal with these problems, Indian have laws made strong rules to protect the independence of auditor. These rules are like safety measures and they are divided into three main types. First, regulatory measures. These are the rules made by the government and official bodies. Second, ethical measures. These are about doing the right thing and following professional values. Third, procedural measures. These are steps or process auditor must follow in their work to stay safe and honest. The Companies Act 2013 lays down several provisions to ensure auditor independence. First, Section 139, subsection 2, mandatory rotation of auditors. Second, Section 141, eligibility criteria for auditors. Third, Section 144, prohibition on non-audit services, which means that auditors should not be influenced by the company they are checking. They must be fair, honest, and neutral. To make sure this happens, the Companies Act has set some rules. Let's look at them. First, Section 139, subsection 2, mandatory rotation of auditor, which means a company cannot keep the same auditor forever. If a firm is auditing a company for too many years, they might become too friendly or biased. So, this section says that an individual can be an auditor for a maximum of 5 years. An auditor firm can be appointed for up to 10 years, but not more than that. Why this is important? Changing auditor from time to time helps bring a fresh and honest check on the company's account. Second, Section 141, eligibility criteria for auditor, which means not just anyone can be an auditor. This section tells us who can and who cannot be appointed as the auditor. For example, the person must be a chartered accountant. He or she should not have any relationship or connection with the company, like being an employee, partner, or holding share in the company. Why this is important? If the auditor is too close to the company, they may not be able to do their job honestly. Third, Section 144, prohibition on non-audit services, which means auditors are not allowed to offer certain extra services called non-audit services to the same company they are auditing. For example, of non-audit services that are not allowed: bookkeeping, internal audit, designing financial systems, management services. Now, why this is important? If auditor are doing other work for the company, they might not report mistakes honestly. So, this rules avoids a conflict of interest. Second point is SEBI Regulations 2050. For listed companies, SEBI mandates first, independent audit committees to oversee the appointment and performance of auditor, which means SEBI says that every listed company must have an audit committee, and these committees should include independent directors. This committee job is to choose the auditor, review the auditor works, make sure auditors are doing their job properly. Now, why this matters? Because this ensures that the company management cannot just hire their favorite auditor. Independent people keep a close watch to prevent any bias or wrongdoing. Next, public disclosure of auditor appointments and resignation, which means whenever a company appoints a new auditor or if an auditor resigns, the company must inform the stock exchange and the public. Now, why this matters? This matters because this keeps everything transparent. Investors and stakeholders go get to know about it. Who the new auditor is, why the old auditor resigned, and if there were any issue. This builds trust in the company's financial practice. Next, a requirement for auditor to follow SEBI guidelines independence, which means SEBI has laid down certain standards and rules that auditor must follow to stay independent. For example, they shouldn't have any financial interest in the company. They must not take up work that can create a conflict of interest. If auditors are connected to the company in any way, they may not report financial irregularities. SEBI ensures auditors stay neutral and professional. SEBI wants to make sure that auditors are selected and monitored by the independent directors. Everything is out in the open, publicly disclosed, and auditors stick to the ethical and independence standards. This helps protect investors and keep the financial system strong and truthful. Our third point is National Financial Reporting Authority, NFRA. NFRA is a regulatory body that supervises auditor of large public interest entities, ensure compliance with ethical standards, conducts investigation into professional misconduct by auditors. Okay, now let's talk about a very important body called the NFRA, National Financial Reporting Authority. Just like SEBI takes care of companies in the stock market, NFRA takes care of auditors, especially those who audit big and important companies. NFRA is a watchdog for auditors of big companies. NFRA keeps an eye on the auditors of large companies, especially those that affect the public like banks, insurance companies, and listed companies. If the auditor makes a mistake or cheat, it can affect thousands or even millions of the people. So, NFRA steps in to monitor their work carefully. NFRA ensures auditors follow ethical rules. Auditor must follow certain moral and professional rules like being honest, not hiding mistakes, and not working in their own interests. NFRA checks if the auditor are doing their job fairly, following the rules of accounting and auditing, staying independent and truthful. If auditor breaks these rules, the public might lose trust in the financial reports. NFRA can investigate and punish wrongdoings. If NFRA thinks an auditor has done something wrong, like hiding fraud or lying in the reports, it can start an investigation, take action like suspending the auditor or charging a fine, cancel their license. This helps the auditor responsible for their action. It's like a teacher checking if students are copying in the exam and punishing those who cheat. NFRA is like a guardian of audit quality. It supervises auditors of big and important companies. It makes sure they follow ethical and professional standards, and it takes strict actions if they do anything wrong. Our fourth point is RBI guidelines for banks auditor prescribes independence criteria for auditors of banking institutions, prohibits concurrent audits, assignments to reduce conflict of interest. Okay, now let's understand how the Reserve Bank of India RBI keeps an eye on the auditors of banks. Imagine you are putting your money in a bank you trust that the bank is safe and handling your money properly. But how do we know the bank is doing everything right? That's where bank auditors come in. They check the bank's accounts and give a report. Now, to make sure these auditors are honest and independent, the RBI has made some important rules. RBI says auditor must be completely independent, which means the RBI doesn't want auditor to have any personal or financial connection with the banks they are auditing. Why? Imagine a student grading their own exam paper. They might give themselves full marks even if they made mistakes. That's why RBI says auditors should be outsider. They should not be employees or have close relation with the bank. This helps ensure that auditors don't take sides and report the true financial position of the bank. RBI says no concurrent audit assignments, which means RBI also says that one auditor should not do multiple types of audits in the same bank at the same time. For example, if one person is already checking day-to-day transactions, concurrent audit, they should not also be doing the final financial audit. This prevents a conflict of interest. If the same person checks everything, they might ignore their own mistakes or not report them properly. In simple, RBI wants bank auditors to be honest, neutral, and not too involved in the banks. Auditor must not do overlapping audit work in the same bank. These rules helps protect people's money and keep the bank's system safe. ICAI Code of Ethics based on IESBA International Ethics Standard Boards for Accountants codes requires documentation of threats to independence and the corresponding safeguard applies, which means the ICAI Code of Ethics is like a moral guidebook for chartered accountant in India. It tells them how to behave in a fair, honest, and professional manner, especially when they are auditing companies. This code is not just made by ICAI alone. It is based on international standards set by the IESBA International Ethics Standard Boards of Accountants, which means our Indian accountants follow globally accepted ethical rules. One of the most important part of this code is that auditors must stay independent. If there is any situation that threatens their independence, like auditing a company owned by a close friend or being offered a gift, they must clearly record this threat and also note down what steps they took to solve this issue. These steps are called safeguards and they help make sure the auditor is not being influenced or biased. For example, the auditor might refuse the gift, ask another professional to review their work, or even step away from the job if needed. So, in simple, the ICAI Code of Ethics helps auditors do their job with honesty, independence, and responsibility, and protects public trust in their work. It is